Investing can often be broken down into a few simple rules that you can follow while investing to be successful. Many of rich investors do not break these rules while investing. While everyone knows you need to buy low and sell high, our temperament often leads us to selling low and buying high. So it's key to develop a set of golden rules to help guide you through the tough times. Number 1. Never borrow money to invest. Engaging in leveraged investing is akin to wielding a double-edged sword. While it presents the opportunity for amplified returns, it also introduces the possibility of intensified losses. The expense associated with borrowing, referred to as margin interest, is the interest incurred on funds borrowed from your broker for buying securities. Margin interest is generally calculated as a percentage of the loan amount and accumulates on a daily basis. When determining your return on investment, it is crucial to consider the cost of borrowing, as it can have a substantial impact on your overall profitability. Leveraged investing is usually not appropriate for every investor. Engaging in this type of investing can be emotionally taxing, given the increased pressure of potential losses and margin calls. This stress may compromise your judgment and decision-making skills, potentially resulting in suboptimal investment decisions. If you are unable to repay the borrowed funds, your lender may categorize the debt as delinquent, causing substantial damage to your credit score. To minimize undue risks, it's essential to thoughtfully assess your financial situation and risk tolerance before engaging in investment with borrowed funds. Only invest an amount that you can afford to lose. Number 2, the best time to invest is now. There is no right time to invest in stock markets. You should invest once you are ready for the same. Attempting to time the market by waiting for the perfect moment, then your time is only on risk. And there is a possibility a perfect time is not a perfect time at all. Instead of trying to time the market, focus on the time spent in the market. Historically, the longer an investor remains invested in the market, the higher the probability of achieving favorable returns. Delaying investment decisions can result in missed opportunities for wealth accumulation. Every day that money remains idle, it loses the potential to grow and generate returns. By investing now, you can put your money to work and capitalize on the long-term growth potential of the financial markets. Number 3, never let your emotions play a role. Emotions such as fear, greed, and euphoria can cloud your judgment and lead to irrational investment decisions. Fear of losses may prompt you to sell investments at the bottom of a market downturn, locking in losses and missing out on your potential recovery. Conversely, greed may lead you to chase hot trends or speculative investments without conducting thorough due diligence, exposing them to undue risk. Emotions can disrupt your long-term focus by magnifying short-term fluctuations and distracting you from their strategic investment objectives. Maintaining emotional discipline allows you to stay committed to your long-term investment strategies and ride out market volatility with confidence. Emotional discipline is a key component of a sound investment strategy. So be strategic and keep your emotions out of investing. Number 4, do the research before investing. Before making any investment, you should do your own research. Many people lose their money in the market due to rumors or false advices. Do not invest in anything which you don't understand. This is the thumb rule you should apply while investing. Research helps investors identify and evaluate the risks associated with different investment options. Failing to conduct thorough research on investment risks can result in unexpected losses and portfolio underperformance. By monitoring industry developments, technological advancements, regulatory changes, and geopolitical events, you can anticipate shifts in market dynamics. By applying principles of behavioral finance and mindfulness, investors can recognize and address common biases such as overconfidence, loss aversion, confirmation bias, disciplined investment decisions. Number 5, stop trying to get rich quick. Many schemes promising quick riches often involve high levels of risk. Whether it's speculative investments, day trading, or get-rich-quick schemes, the potential for significant losses is typically high. Quick wealth accumulation schemes often lack sustainability. They may rely on unsustainable business models, speculative bubbles, or unsustainable market trends that are prone to collapse over time. Investors chasing quick riches may overlook fundamental investment principles such as diversification, risk management, and due diligence. Instead of conducting thorough research and analysis, they may rely on speculative tips, market rumors, or investment fads without fully understanding the underlying risks and potential rewards. Number 6. A genius is about to know when to stop. One of the primary reasons for knowing when to stop in the stock market is risk management. All investments come with inherent risks, and it's essential for investors to set predefined exit points or stop-loss levels to limit potential losses. Intelligent investors recognize that preserving capital is paramount and are willing to exit positions if they believe the risk of further losses outweighs the potential for gains. Fear, greed, and anxiety are common emotions that can drive investors to make impulsive decisions, such as holding on to losing positions for too long or selling winning positions prematurely. Intelligent investors have the emotional intelligence to recognize their emotional biases and the discipline to act rationally. By setting predefined exit points, maintaining discipline, and staying attuned to market dynamics, intelligent investors can navigate the complexities of the stock market with confidence and resilience, increasing their likelihood of achieving long-term financial success. As we bid farewell to these discussions, let us carry all the lessons learned and the wisdom gained into our own financial journeys. If you discover value in this video, kindly subscribe and share it with someone you care about and wish to inspire on their journey towards financial success. From the bottom of our hearts, thank you for joining us today. See you in the next video. Until then, take care.